Okay, dear students, I'm Abil Ahmed, CEO and Principal of Abil School of Accountancy and SBR expert. Let us quickly discuss a new area in SBR, which is IFRS 19. IFRS 19, the title is Subsidiaries Without Public Accountability. First of all, you need to develop the understanding of this. What do you mean by subsidiaries without accountability? When we say you have got subsidiaries, they do not have public accountability. It means number one, your subsidiary is not a financial institution, means your subsidiary is not a bank. Of course, if your subsidiary is a bank, then it does have a public accountability. Then you have to give the detailed disclosures. So number one, when we say subsidiaries without public accountability, it means it's not a financial institution. Your subsidiary is not a financial institution. Your subsidiary is not a bank. Second, your subsidiary is not a listed company. Of course, when your company is a listed company, your subsidiary, if your subsidiary is a listed subsidiary, if it is a listed company, then you have to give all the disclosures. So first of all, when we say subsidiaries without public accountabilities, it means the subsidiary is not a bank. Second, subsidiary is not a listed company. It means a private company. Okay, that is the meaning of subsidiaries without public accountabilities. Now, basically, we have a parent. There's a subsidiary, let's say S1. Now, basically, parent, obviously, parent follows all the ISS and IFRS. And parent is going to decide that either the subsidiary is going to follow all the ISS and IFRS, or subsidiary is going to prepare the financial statement according to the local GAAP. Now listen, if your subsidiary also follows all the ISS and IFRS, okay, then of course in that case it becomes very easy to prepare group accounts. Then obviously preparing group accounts is not difficult. It becomes very easy. But if your subsidiary is not preparing their individual books according to ISS and IFRS, let's say your company is actually, number one is subsidiary follows all the ISS and IFRS, then of course group accounts, they are very easy, no issue at all. If your subsidiary is following all the ISS and IFRS, then no problem as far as group accounts are concerned. There's no issue at all. No issue at all. Okay. Now there's a possibility that S1 is following the local GAAP. If your subsidiary prepares individual books according to the local GAPs, then your subsidiary will have to actually prepare few additional, I would say, financial statements, so that to bridge the difference between what recognition and measurement requirement under ISS and IFRS and under the local GAAP, so that group accounts can be prepared. Okay. The issue is when your subsidiary is actually following all the ISS and IFRS, okay, that does make group accounts very easy. But there is a problem. The problem is providing all the disclosures could be onerous for the subsidiary. Basically, subsidiary might not be having so much benefit of giving detailed disclosure of each and everything. There's a possibility that cost of providing each and every disclosure might be more than the subsidiary gets the benefit. Okay. Now here basically IFRS 19 can help the group. How? According to IFRS 19, if your subsidiary is a subsidiary which does not have a public accountability, then under IFRS 19, your subsidiary can simply show the reduced disclosures. But one, your subsidiary does not have a public accountability. And second, ultimate parent is preparing the group accounts which are available to the public, and ultimate parent is preparing the group accounts according to proper ISS and IFRS, and those group accounts are available to the public. If both the conditions are met, in that case, your subsidiary can, under IFRS 19, show the reduced disclosures. Now, what is happening? We have parent S1, S2, assuming 90% holding, and let's say I've got holding 60% here. So let's say S1 is not a financial institution, it's not a bank, and it's not a listed company. So under and let's say obviously ultimate parent is preparing group accounts which are available to according to ISS and IFRS, and that group account, those group accounts are available to the public. So in that case, under IFRS 19, S1 will get the discount, and the discount is your subsidiary S1 will show reduced disclosures. This is what exactly you just need to know. Look at this second paragraph. If the subsidiary applies IFRS, financial statement of the parent and the subsidiary can have the same accounting policy, making the preparation of consolidated financial statement easier. However, here is the problem. The IFRS disclosure requirement can be onerous for a subsidiary to prepare. If the subsidiary applies local GAAP, there are fewer disclosure requirements. However, the subsidiary may have to prepare retained extra records in order to bridge any differences in recognition and measurement of between the subsidiary's individual financial statement and group accounts. Reduce disclosures. To reduce burden of the disclosure for a subsidiary, an entity can choose to apply IFRS 19 subsidiaries without public accountability disclosures. According to IFRS 19, subsidiaries are able to apply IFRS 19 if they do not have public accountability, and ultimate parent entity produces consolidated financial statement with IFRS and accounting standards, and which are available to the public. By applying IFRS 19, subsidiaries will still follow the recognition, measurement, presentation requirement of other IFRS standards, but the disclosure requirement will be under IFRS 19, which have been reduced. Only here, detailed disclosures are required. If an entity applies any of the following standards, then entity must comply with the full disclosure requirement. That is IFRS 8 operating segment, IFRS 17 insurance contract. We know that it is not a part of SBR syllabus. IAS 33 EPS. For eligible subsidiaries, the application of IFRS 19 should enable companies to simplify their reporting process and reduce the cost of preparing financial statement. Entities will no longer need to keep two sets of records, one for local and one for IFRS. So as I mentioned you earlier, a very small area of IFRS 19 is within the syllabus of SBR, and there's a possibility you might be having a question around, I would say minimum 2, maximum 4 marks question in section A, and pure discussion, nothing else. And one more thing before I just end this small lecture. Student, we have covered IFRS. If you recall IFRS 18, we have revised at least 2 to 3 times in our live revision classes. And I think I did mention one thing many times, that from here onwards, when you will be answering your questions in SBR, just by writing this, that this transaction impact goes to statement of P&L, you will not be, either you will not earn marks or you will earn half of the marks. Because now IFRS 18 is a part of your syllabus. So from here onwards, whenever you will be writing the answer, okay, now you will have to mention, when you will be saying that this transaction impact will go to the statement of P&L, so you have to mention which category as well. Because the biggest impact which IFRS 18 is having, that is on, I would say, P&L. Now, in P&L, we have 5 categories: operating category, investing category, financing category, income tax category, and discontinued operations category. So from here onwards, if there is any transaction which affects the P&L, you have to exactly mention that under which category you have to show that XYZ impact. For example, we are a manufacturing business, so obviously depreciation is a part of cost of goods sold. So depreciation, when you're saying is a part of goods sold, so it means we have to show the depreciation under that operating category. So you have to show us under which category we have to show the items which you are taking to the P&L. Another example could be, for example, my company has bought the investment property. Of course, we bought the investment property for capital appreciation. Now, the change in the fair value under IAS 40 investment property fair value model goes to P&L. But just writing that change will go to the P&L, you're not earning marks. Either you're not earning marks or you are earning half of the marks. Now you have to mention that the change, the fair value gain on investment property will go to number one statement of P&L, and under investing category we have to show. But a very interesting thing you need to know, if it is the main business of the company to buy the properties to give on rent or to sell them, if it becomes the main business, let's say your examiner says that this is the main business of the company to buy the properties, keep them for capital appreciation, or to give them on rent. If it is mentioned it is the main business of the company, now even though it is an investment property, but examiner says it is their main business, now the fair value change will go to the P&L, number one, under IAS 40, and second, you have to show that change under operating category. So students, you have to make sure just by writing that gain or loss will go to P&L, you are not earning marks. For example, we have bought shares in XYZ company for trading purposes. So we know that number one, it is a financial asset. Second, change in the fair value, of course, will go to P&L. But you have to mention, since it is financial asset, and obviously whenever I'm making investment in equity instruments, so the only intention is investment. So here, whatever the fair value change comes on my investment, I will take that gain or loss to the investing activity. Under investing category, I have to show. And if you recall, so we have discussed a very, I would say, detailed list of transactions when the impact will go to the P&L and under which category you have to show. So if just a minute, if I show you that document, I hope student you can see that. Can you see this category, operating income and expenses? Anything not classified as investing or financing, or one more thing, main business activities. Examples, what comes under operating category: revenue, cost of sale, depreciation, amortization, gain or loss on disposal of property, plant and equipment, current and past service costs from a defined benefit plan. So you can see that under operating category, under IAS 19, you have to show current and past service costs here. Look at this investing category. Investment in associate and joint ventures, cash and cash equivalent, return on asset that generate income independently from other sources. For example, financial asset, as I was mentioning. But I'll give you more detail on these financial assets. You have to just wait. Look, investment in associate, joint venture, cash and cash equivalent, return on assets that generate income independently from other resources. For example, financial assets, unconsolidated subsidiaries. Now you might be thinking, so which subsidiaries are unconsolidated subsidiary? If you can prove that your subsidiary is immaterial for you, then you can leave that subsidiary. Then that subsidiary can be unconsolidated. Look at this: interest income, dividend income, rental income, income or expense from the initial recognition, subsequent treatment of financial assets. For example, from remeasurement of fair value through P&L, financial asset. So you can see that what we have to show in investing activities. Then financing, that is also very important. Liabilities from transaction that involve only the raising of finance. For example, financial liabilities. Liabilities from transaction that do not only involve the raising of finance. For example, pensions, provisions, leases. Interest on borrowing. So obviously when you have taken the loan, interest on borrowing you have to show under financing category. Interest on the lease also you have to show under financing categories. Unwinding of discount you have to show under financing categories. Interest on pension liability, this is very important. Now current and past service costs you have to show under operating categories, and interest costs on pension liabilities you will show under financing categories. So things are now getting very interesting. Note that only the interest expense element arising from these transactions is included in financing. Any other income expense related to the liability that would be included in operating For example, current service costs on pension schemes. Obviously, we know that current and past service costs you have to show under operating category. So students, you need to know these things, I would say, in a really big amount of detail. And I have, during my regular classes in the revision, we have also discussed, if investment in individual books, it is at fair value, then changes will go to where you have to show the changes. If you are following equity method, then where you have to show the changes. So we have discussed that as well. So students, but at least category, income, expense, and examples, I strongly believe this will really help you while answering your questions in exam. So let me just show you one more page. Student, look at this page also. I think this will also help you a lot. First of all, please read the heading carefully. Investment in these assets as a main business activity. If it is your main business activity, category for related income and expense. Investment in associate, joint ventures, and unconsolidated subsidiaries that are accounted for at cost or fair value. So if you are keeping in your books, in your individual books at, I would say, cost or fair value. Number one, investment in these assets, this is your main business activity. But how you are keeping these investment? Either on cost or fair value. In that case, changes will be shown under operating category. Now, investment in associate, JV, and unconsolidated subsidiaries that are accounted for using equity method. If you are following the equity method, now the changes you have to show under investing activities, even though it is your main category of the business. The last one is also important: asset that generate returns independently of other resources. For example, financial asset, investment property. Look at this operating category. So student, if your examiner says it is their main activity, it is their main business, then even the changes of fair value under IS 40 fair value model you have to show them under operating categories. For example, main business activities providing finance. For entities that provide finance as a main business activity, for example, bank and building societies, income and expense that would usually be classified under financing category may be classified under operating category. Why? Because this is the main activity for the bank. It is the main activity for the bank. So I hope now you should be having a 100% very clear idea when the changes are hitting the P&L, which category they will have to go. So students, that is all about, especially I just wanted to discuss IFRS 19, which is a very small part of SBR, but I thought, no, let me facilitate SBR student across the entire world, global, because IFRS 18, we know that it is a part of syllabus, but these two, I would say, you can say slides or PDF, which I've just shown to you, they will really help you a lot. So in a very short period of time, we have discussed IFRS 19 and just a little bit revision of IFRS 18. And management, MPM students, I have already discussed MPM in a really big amount of detail in the previous class. And students, management defined performance measures, I have already discussed in the previous class in a really big detail, I would say. So student, that is all about IFRS 19 and a quick overview of, I would say, IFRS 18, not more than that. So from my side, best of luck for your SBR exams. I strongly believe this video will definitely help you in IFRS 19, and definitely it will help you in 18 as well. So thank you very much.